Now, as the world faces a growing number of natural disasters, one investment tool is attracting unprecedented interest from investors worldwide: catastrophe bonds, or cat bonds. Now, these are a form of insurance-linked security. Investors lend money to insurers, and if no major disaster strikes, they earn high returns. But if catastrophe hits, part or all of that money is then used to cover the losses. This year's issuance has already shattered records, topping $18 billion. And it's only August, surpassing the total for all of last year. So what's driving this boom? Well, mostly climate change, which is making disasters more frequent and, of course, more costly. And cat bonds offer very appealing high interest rates. The yields typically range from 5 to 10%, but some high-risk options can pay up to 20% a year. Cat bonds move to a different beat from stocks and bonds. Their value depends on the weather, mostly, and it isn't linked with the financial cycles. Now, Jean-Louis Monnier is Senior Executive at global reinsurance giant Swiss Re. Jean-Louis, thanks so much for joining us. I wonder if you could just take us through how these cat bonds work and how they're different from reinsurance.
Yeah, effectively at the core, they allow transfer of insurance risk to capital markets. But in the middle, you have a special purpose vehicle to which the risk would be transferred into. And that special purpose vehicle then issues securities that investors can invest. And that special purpose vehicle raises money from investors, and these proceeds are invested in very safe collateral, which is there to pay the losses for the protection buyer. So this is a market that has been used by insurers and reinsurers, but also more recently countries and corporations.
Now, cat bonds, I understand, sort of began in the mid-1990s after, I think it was Hurricane Andrew. It seems it's mostly about climate, but it also worked during COVID, if I'm not mistaken. So how big is the market these days?
So the cat bond market is, in terms of outstanding, $55 billion in capacity. The alternative capital market, more broadly, that includes collateralized reinsurance and also sidecars, it's about 110, 120 billion, which is around 16% of the overall capacity which is being provided by reinsurance and alternative capital markets. So it is a growing share of the sessions are being transferred to investors in this way.
I'm just wondering, how investors judge a market that's essentially climate controlled. And we know that climate risks are increasing. So surely as weather extremes increase, the risk of losing all your investment does as well if there's a massive, massive claim. And yet the popularity grows.
So maybe a few thoughts on that. The first one is that climate change is a long process, and the models, usually are, adjusted and adapted to try and accurately model the risk that is being ceded. So at the core, you have the best view of, scientific view of what the market is. And the second one is that if you look at the root cause for increase in catastrophe losses in recent years, most of it actually come from two elements which are outside of climate change. One is demographics, the move of population towards coastal and more risky areas. And the other one is the inflation. Rebuilding costs have gone up. So those two factors have contributed to an increase effectively in exposures and an increase in demand for risk capacity, especially in the US.
I know that with increasing climate issues, like massive fires or flooding, even during COVID we saw this, is that insurers were really worried that they wouldn't be able to actually pay their clients in the event of massive risks. And the questions being asked then are, we'll get to a stage where you cannot insure because the risks are just too big, despite all these vehicles to sort of cover the risk. Do you think we're moving in that direction?
So that's an interesting question, because what we're seeing is that capital markets actually provide that additional pool of capital and capacity that allows the key peak perils to be seeded. And from a capital markets point of view, if you're capital markets investors and you allocate a small proportion of your assets to, insurance risk, you can actually withstand a loss. Let's say you're a pension fund allocating 1% of your allocation. You could withstand a loss on that 1% as long as you have a long-term view and can recoup, from the premium potential losses. So all I'm saying is that 55 billion is actually quite small compared to the trillions of capital that are available in capital markets, and there is room to grow, and we're very confident that capacity will be provided, for the long term. And maybe one last point, if we look at how the market grows, it tends to be growing for those peak US perils. 70% of the risk ceded currently in cat bonds comes from US hurricane. So the market is actually exercising that very role right now of being the complementary capacity to the reinsurance market for the riskiest of all perils.
Thank you so much. Really interesting to chat to Jean-Louis Monnier, Senior Executive at global reinsurance giant Swiss Re.